Pension investing can be quite confusing. You got lots of options, you got lots of acronyms, and it can be overwhelming. So in this video, you will receive a simple flowchart to make an optimum strategy for your pension investments.
I have a dream, that's all I need. I'll make it happen with some work and belief.
This video is part of a 5-episode series around pension investing, and I want to guide you step by step through the main elements and the main questions of pension funds. Now, this is important. I said this before, I am not an investment advisor, and this video is not meant to be investment advice. It's simply an aspiration of me to educate you to a stage where you can have a proper discussion with an investment advisor, or if you are comfortable with it, also do the pension fund investment for yourself. Let's get straight into it. Last time around, we talked about 2 key questions. One is, at what age do I want to retire? And number 2 is, how much money do I actually need? If you haven't watched that, please feel free to go back, watch that, and come back here. And as last time, what I've also done is summarize the key aspects of whatever we talk about in this video in a little workbook. If you've signed up for that last time, this should be in your inbox. And if you haven't signed up, there is a link down in the description box below. If you click on it, follow the instructions, you will receive that workbook from both the last time and also this episode. So what we want to cover in this episode is all the options that you have to put your money into. Let's start our content with a very inappropriate question. How old are you, and have you ever bought a house? Feeling uncomfortable? Well, here's the thing. If you have never bought a house here in the UK, and if you are less than 40 years old, you can actually open a so-called lifetime ISA. And ISA stands for Individual Savings Account. And if you haven't bought a house, and if you are under 40 years of age, then I envy you, because you have got a great opportunity at hand. What the government always tried to do is encourage young people to save, but also be able to buy their own home. And so if you invest into a lifetime ISA, what the government does is it tops up every contribution that you make by 25%. So, in fact, you get a 25% return on your investment straight out of the box. Doesn't get better than that. Now, of course, that is not for an unlimited amount. You can invest up to £4,000 into it every single tax year. And once you opened that lifetime account, and if you pass 40 years of age, it doesn't stop there. You can still invest into that account year by year, and you will still receive the investment contribution from the government, the 25%, up until the age of 50. So what are the downsides? Well, first of all, you have to keep the money in the account until, well, either you retire or you want to buy a home. There are a couple of other things, like if you get terminally ill, you can also withdraw the money. But the main thing is, once you buy a home, you can use that money to either pay down a mortgage or also make your down payment. And if it happened that you have to withdraw the money for other reasons, well, it's not the end of the world. You would not be eligible anymore for the government contribution. So the 25% that you've received in the account, you would have to pay back. But the rest of the money, you can always withdraw. Beyond the lifetime ISA, you have 2 main options to invest your pensions. One is into a pension fund, and there are again different options. And one is an ISA account, an individual savings account. We get into the pros and cons of those in a moment, but before that, you can do something very simple. If you are employed in the UK, then there is something called an obligatory enrollment into a pension fund. So if you do nothing, your employer will enroll you in a pension fund or in a group pension fund, and they will make contributions to that. How it generally works is that if there is a percentage that your employer contributes to that pension fund, you have to match that amount. So for example, if the employer pays 4% into the pension fund, you at least have to pay 4% into the pension fund as well. So you contribute a little bit, but overall, well, you only pay for 4%, you save 8% per month, and so it's essentially like free money. So far, first you pay into your lifetime ISA fund up to £4,000, and then you invest at least the minimum amount that the company will also contribute to your pension fund. After that, the options become a little bit more complex, but they're not very difficult to understand, so we'll break them down now. Here's what we've learned so far. If we are less than 40 years of age and we consider ourselves a first-time buyer in the UK, which means we haven't bought a property in the UK before, then we are able to save up to £4,000 into a lifetime ISA. If the answer to that is no, or if we are above 40 years of age, then our best bet is first and foremost to contribute to a company pension fund. And of course, by the way, if you've used up your £4,000 of a lifetime ISA saving, you can still contribute the rest of the money to a corporate or a company pension fund. Now, initially, we contribute as much as the company would match in our payments to that company pension fund. But the question becomes, how do I choose whether to continue to contribute to that pension fund or rather invest in an individual savings account? And to answer that question, we first have to understand the concept of the two. The main difference between a corporate pension fund and an ISA account is first and foremost taxation. In an ISA account, you do not pay capital gains tax, which means that whatever money you earn or gain in your investments in an ISA account is tax-free. However, the money that you put into the ISA account is taxed as normal. So you will receive your paycheck, you will pay taxes on whatever income you have, and then you can save that amount of money that is left into an ISA account. With a pension fund, things look a little bit different. You pay into a pension fund before you pay taxes. So if you're employed, those contributions to a pension fund will typically be taken off your paycheck before the normal basic tax rate or a higher tax rate is applied. In addition, once you are eligible to withdraw money from your pension fund, you also have a certain amount of money that is tax-free, which currently is 25%. So if you look at the two, the main difference is that with a pension fund, you will defer your tax payment, whereas with an ISA account, you pay taxes now, but anything that happens afterwards is tax-free. To understand what is better for you, we have to look at an example. Let's assume we wish to invest £100. And let's also assume that we expect a 5% return on investment and we are looking at a horizon of only 5 years. After 5 years, our £100 will be worth £128. That is the amount of money we would at this stage have in an ISA account. Now let's have a look how this calculation looks like if we would invest that same amount of money into a pension fund. Given that the investment into a pension fund occurs before taxes, we actually have more money available. In fact, we can invest £125 and after tax we would still have the same amount of money left. When we then compound our £125 over 5 years and 5%, we achieve £160. With our current tax laws, 25% of that is tax-free, so 40 of that is tax-free. We pay taxes on the remaining £120 and let's assume we are paying 20% tax, which leaves us 96. 96 plus 40 is 136. That is still reasonably close to the 128 that we would have achieved if we invested in an ISA account. Now let's look at the same example if we were a higher taxpayer. In that case, our £100 after tax is actually worth £167 before tax. If we do the same thing again, compound that by 5% over 5 years, we achieve £213. 53 of that is tax-free and the rest taxed at 20% gives us £128 plus £53 is £181. Now that is a huge difference to the £128 in an ISA account. What we see through this example is that if we are a higher taxpayer, it is very advantageous to defer that tax and invest in a pension fund. Whereas the difference between the ISA account and the pension fund at a lower tax rate is not so dramatic. And of course, in an ISA account we can take out our money whenever we wish and we have more flexibility. With this example in mind, we can now answer our question how much we should contribute to a company pension fund. And as we've seen before, it very much depends on the taxes that we are paying today. Are we a basic tax rate payer or are we paying a higher tax rate? If we are paying a basic tax rate, it may be advantageous to invest into an ISA account because the benefit of deferring that tax isn't very high and we gain the flexibility to take our money out whenever we wish. If we are a higher tax rate payer, then we may want to defer that tax payment and contribute to the company or our own pension fund and benefit from a possibly lower tax rate later when we retire. So what we've seen so far are 4 levels of basic investments. It started out with the lifetime ISA up to £4,000. Then the basic contribution that you want to make to your pension fund up to the amount that your company matches and pays into your pension fund. And then you have to look at your salary. And if you are paying a basic tax rate, so here in the UK 20%, then you might be better off to put that into an individual savings account. But if you pay 40 or 45% tax, there are strong arguments to actually put that and invest more money into a pension fund. Okay, small recap. In episode 1, we talked about when we want to retire and how much money we need. And then following up from there, in today's episode, we talked about all the various options that we have on our hand to invest our money into. The next logical question, of course, is where do we want to invest? Is it better off in the stock market? Should we look at the bond market? Should we look at something else? And that is something that we want to cover in the next episode. We'll talk about exchange traded funds, we'll talk about the cost of investment. We'll also give you a couple of resources that you can find online that will help you to make those decisions. So I look forward to seeing you in the next video.